Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the retail sales number, an indicator which gives us insight into the personal consumption, the largest category of GDP. In today's lesson we're going to look at another market moving indicator which gives market participants insight into growth or lack thereof in the manufacturing sector of the economy, the Institute for Supply Management's Manufacturing Index. So let's get started.
Reported on the first business day of the month at 10 a.m. Eastern Standard Time, the Institute for Supply Management, or ISM Manufacturing Index, is comprised of several different sub-indices, the five most important of which are the Production Index, which gives insight into industrial production, the Prices Index, which gives insight into the Producer Price Index, and this is an important inflation gauge which we're going to cover in our next lesson, the New Orders Index, which gives insight into factory orders, the Employment Index, which gives insight into manufacturing employment, and the Supplier Deliveries Index, which is an important component of the Leading Economic Indicator Index, another important indicator which is designed to predict future growth or lack thereof in the economy. The sub-indices and therefore the headline number are derived by a national monthly survey of purchasing executives at several hundred industrial companies. As part of this survey, these influential manufacturing executives are asked a series of questions to gauge the level of growth or lack thereof their companies are experiencing in the above components. In response to these questions, the executives can give only one of three answers, which are better, the same, or worse. As stated on the ISM's website, once these questions are received, the ISM indexes are calculated by taking the percentage of respondents that report that activity has increased, or in other words, respond with better, and adding it to 1/2 the percentage of that report that activity has not changed. In other words, that respond with the same. Okay, using half of the same percentage effectively measures the bias towards a positive above 50% or negative index. As an example of calculating the index, if the response is 20% better, 70% same, and 10% worse, the index would be 55, okay, and that's how it will be calculated there. All right, the math isn't so important here, but the two things that it is important to understand about this index are that readings above 50 indicate an expansion over the previous months in the component indexes or the overall manufacturing index if you're looking at the main number there, and a reading below 50 indicates a contraction. Okay, generally releases which beat estimates to the upside will rally the markets, and releases which which come in below estimates will result in market sell-offs. This is especially true, and moves can be especially large around turning points in the economy where uncertainty reigns, and a leading indicator such as this carries a lot more weight. Although the U.S. economy is now primarily a service-based economy, the ISM index is still one of the most important and therefore market-moving indicators for several reasons. Firstly, although no longer a dominant part of the economy, manufacturing still plays a large role. Secondly, the prices paid and employment components of the indicator give a read on what's happening with inflation in the labor market, two very important components of the economy. Lastly, and perhaps most importantly, is the fact that before goods are sold to businesses and consumers, they obviously have to be manufactured. So this is in general the first area where signs of strength or weakness in the economy tend to show up. The ISM Manufacturing Index is therefore considered a leading economic indicator, or one with predictive powers on what's going to happen over the next several months with the economy, and therefore a lot more weight is going to be placed on it by rather than indicators that are giving indication of current or past things. So unlike many other of the other releases that we've covered or will cover, the report issued along with the ISM manufacturing number is very easy to read. I've included a link to an example report just below the video if you're watching it on informedtrades.com, or in the description section if you're watching it on YouTube, so you can get a look at that there. As with the other indicators we're studying as well, it's important to follow the release in real time for several months to get a feel for what the market is focused on at the time, because how it reacts is going to change depending on where the focus is in the economy and in the markets at the time. And then you can begin to anticipate market reactions under different scenarios and incorporate that into your trading. With this in mind, and as with all the indicators that I cover, I'm going to be posting a discussion starter in the comments section of this lesson on the date of the next release, a link to which you can find in the description section if you're watching this on YouTube. If you'd like an email when that discussion starts, you can subscribe to the thread by going to Article Tools once logged into the forum and selecting Subscribe to Thread, and you'll automatically be sent an email by the forum when that discussion starts. Okay, that's our lesson for today. In our next lesson, we're going to turn our attention to some of the indicators which focus more on inflation than economic growth, starting with a discussion on the Producer Price Index. So we hope to see you in that lesson. As always, if you have any questions or comments, please leave them in the comments section below, and have a great day.